Hello, everybody. Kirk Spano. How are you doing today? Investing 2020s. Going to unleash the plug and play ETFs on you today for the quarter and have some big changes. We're going to run through the market in general real quick. Just some interesting charts that I've seen, some interesting abnormalities that I've seen. And it tells me that this market is getting ready for something different. And I'm not sure if different is one last rally up or if we're going to get a bit of a pullback here in the next quarter. I suspect the latter, not the former, but who knows? I'll tell you, the economy clearly is on an uptick, a lot of revenge spending, but I've seen some other interesting numbers for the economy which indicate that what I've said all along, which is that the overriding theme in the economy is slow growth forever, with deflationary forces that'll be manifesting for another decade or two, maybe even three, because of the whole demographic situation out to the middle of the century, that I'm not so sure that even with low interest rates, if these valuations are justified, given that they are at record levels. So let's take a look at that real quick. First off, and in case you are a Wall Street Journal, Barron's, and MarketWatch reader, I will tell you they have some pretty good specials going on right now. Create a profile at any one of these. And with MarketWatch, you can get MarketWatch and Barron's for $9.99 a month, I believe it is. It might be $11.99 a month. But if you really want to split things up, you can get Barron's for $52 for your first year, and then MarketWatch for $10 a month. I have no idea why MarketWatch costs more than Barron's. It doesn't make sense. But what they'll do when you subscribe to MarketWatch is they'll offer you the Wall Street Journal for $4 a month. So you get the whole bundle in a convoluted way. MarketWatch, the Wall Street Journal, and Barron's, all of them together for under $20 a month. So it's an interesting way of marketing. It's out there. Make sure you hunt for it if you want these things. If you have one and not the other, I will tell you, cancel all your subscriptions and watch the special offers roll on in over the course of a week or two. In any case, the Black Swan Index, also known as the Skew Index, it's a way of estimating when surprises will be. I guess that's the best way to understand it. And when the market is acting funny, you would expect surprises. And I'm going to show you something in a minute that, in fact, the stock market is acting funny. And the Skew Index is just off of an all-time high. Over at Sentiment Trader, we can see it a little bit better. Is that it peaked here a little while ago, pulled back, and you'd expect it to rise again, I think, if the market continues to rise. Where is this coming from? Well, you have that smart money, dumb money index that I look at a lot, but look at this. The dumb money and the smart money both moved in the same direction for a while. When this happens, it implies a slightly negative return over the next couple of months. Looking at it together, and then separating out the put trading and the call buying, you'll see that small traders, after revving up their put buying a few months ago, put buying is through the floor again. But the big guys, put buying is through the floor again. So what we have is, whether it's the long side or the short side, the big money, the smart money, and the dumb money, the small money, are all moving in the same direction. That doesn't happen. That's why the Skew Index is so high. This is a very euphoric market, despite the fact that I don't think anybody talks too euphorically. They just put their money in that direction. So your put to call premium, again, is super, super low. Selling covered calls, which I don't do a lot of, is a pretty good deal right now. So if you have positions that are overbought, you should be trimming a little bit and selling some covered calls maybe 5% or 10% out of the money, but that's about it. And look at all the debt, all the margin debt through the roof. So not only are people betting mainly on the long side all of a sudden, because a few months ago they started to go bearish and now they're all bullish again, with borrowed money. Given what the Fed's been talking about trying to tighten things up just a little bit. And right now they're just using rhetoric. They haven't really done anything. What does that tell you? At some point, it's going to be hard to borrow like this. And then those options are going to come off and they're going to go negative. We could really see somewhere in the range of 15 to 35%, almost straight down, depending on when new buyers come in. And because there's so much cash in the richer parts of the economy, I think those buyers would probably come in sooner than later. I think most people are looking for the closer to the 15% correction than the 35% correction. Mathematically, given all the money that's out there, I still have a hard time seeing a 35% correction just because that hasn't tightened. I guess it's that easy, but valuations are crazy. This article just talks about what I just said, which is that the smart money was behaving a lot like the dumb money. So which one is smart and which one is dumb? I don't know. I think they might both be dumb right now. So some of the valuations that we look at, Buffett indicator, this is a month old. It's not completely up to date. New one should be out any day now. But the market's a shade higher, so this isn't any lower. Record Buffett indicator, corporate equities to GDP. Then the alternative, the Wilshire 500 to GDP. Just not enough money being earned across the economy to support this very long. Not that it can't go a little higher. It can always go a little higher. It just means that it'll fall down a little harder later. And then look at this. All four of these methods are screaming super overvalued to overvalued. So the super overvalued is Q ratio, which we'll look at a little closer in a second. Crestmont, which is one of my favorites, which we'll look at in a second. The Shiller PE, right about there. And this is the one that basically gives you an estimate of forward returns. Forward returns over the next 10 years are looking almost flat. Then the S&P composite from its regression, which is way over here too, highest of all time. Again, how much do we adjust for interest rates? I don't know. Shouldn't be more than about 20% of a fudgy area, because you just take the inverse of a normal interest rate and subtract where we're at. You know, I mean, maybe we could go double all time. Maybe, if we're crazy. But 20, 30, 40, 50% extra is probably as high as it should be, and 20% really makes the most mathematical sense. And we're there. And not just 20% above normal, but if normal is actually right about here, right? That's where you get all your jitterbuggies and things like that. And as I've told you, since 1980 is the new world, especially .com boom, real estate boom, QE era, how far down can it come? Somewhere in here makes a lot of sense. I have a hard time thinking it'll get to here. I just don't think the Federal Reserve and our central banks will let it happen. They'll just say, hey, print money works. Let's print money. Q ratio, right? So remember, it's leverage on leverage. When was the last time that we were talking about leverage on leverage? Well, it was actually twice in the last 13 years, right? I was talking about it at the start of 2020 and the 2019, leverage on leverage. But I also talked about it back in 2007. That was way lower. So leverage on leverage here is at an extreme. Is the market cap still cheap? Well, it's hard to tell because of the interest rates, but probably not. Trailing PE is 28. That's way high. I mean, really, if you thought about it as a businessman, would you ever want to wait so many years to get your money back? Well, it's not the highest, right? Not adjusted for inflation, it's not the highest. Still pretty high. Usually get a pullback again. 15 to 35% correction is, I think, what we're going to be looking at. I think probably closer to 15, just because of the funny money out there. But then the rally after that, which could last a few years, runs right into that middle of the decade that I've been warning about, 2026-ish, 2027, 28, 29, 30. We could set new highs, 20 or 30% higher on the rebound from whatever the next correction is. Then, holy crap, a few years from now. What happens then? And what do these things look like if we don't get a real infrastructure plan? I think that's a little bit in doubt right now. The president has no stomach for just ramming things through, just trying to get the appearance of bipartisanship. I don't know exactly how the politics play out there. So here's Crestmont, real good research firm. You do well to visit their site. Again, Crestmont's measure of PE at a record high. Regression should be back to the red line. I just want to show you something, how the last 4 gigantic bear markets turned out. Notice the recovery from over this period of time. So normalizing for a period of time from the event. Great Depression was still negative after 13 years. The 2000 correction took a better part of a decade to get back to even. 1973, though, there was a massive rally after the 1973 bottom, and this is when Warren Buffett made most of his money. But what was the difference here? Changes in energy. And then coming off of 2007, we're up quite a bit. They call it the 2007 financial crisis because really the markets peaked at the end of 2007. What we can see is what it looks like in the last year. That's an awful lot of that gain. So here's 2020, January 2020. It's back there just a year later, then still rallies. So could we go a little higher? Sure, we can always go a little higher, especially since interest rates are lower on this one. But the big growth from China and the emerging markets, it's lower now. Interest rates really can't go any lower without really screwing up the banking system. Kind of a catch-22 there. Now, how does the next correction or series of corrections look? Small correction, rally to new highs, big correction. So take a look at advisor perspectives. These charts are pretty interesting. And here's the rally off of 2000. Well, from the 82 bottom to 2000, 666%, minus 59%. Now we've made all that back, 339% off the 2009 bottom. So that 339% literally go higher, but it's normal-ish compared to all the other big bull market recoveries off of recession collapses, financial collapses. So is this correction, is this bull market going to end similar to these? Similar to this? Hard to know. But low interest rates, oil's probably about as high as it's going to get unless there's a war, right? United Arab Emirates and Iran both want to pump more, so they probably will. So what I'm trying to do is warn you that you better be very diligent on your trading and your risk management, because things are funny right now. Funny, weird, dangerous. So on the plug and play ETFs, I thought it was interesting that Morgan Stanley put out an article this week, 3 mega trends, a surge in consumer spending. We've been talking about that for quite a while. An expansion of the digital economy, tech, talking about that for a while, asset light investing. And then the emerging generation of millennial investors. Been talking about that a couple of years. So it's nice to see that Morgan Stanley caught up to me again. So go to the plug and play ETFs for the third quarter. Markets are back to being historically overvalued. just like January 2020, but even more so. Only easy, cheap money from central banks justifies lofty valuations, but for how long? If you gravitated away from higher cash percentages to take part in the rallies, it's time to gravitate back towards the more conservative end of your asset allocation, right? So I was very unsure of things last year because of COVID. It took me until the end of last year to really gravitate towards a more full asset allocation, tweaking these a little bit, my cash holdings. But I'll tell you, I'm still pretty heavy in cash, and I've picked up a little cash here in recent weeks. I told you I sold some of the SPACs that had not cut a deal yet. Not because they're bad investments, just because I wanted the cash. I can wait to see what deals they make. The only one I kept was Kozla because it didn't have any warrants. I didn't have to worry about dilution in the future. So it really was a pretty good store of value, right? That $10 is really worth about $10. No dilution from future warrants. So finally, the biggest secular trend that is a change from the recent past is a shift to clean energy. Your entire investment mindset needs to grasp that and consider that in almost everything that you invest in. So between technology and the shift to clean energy, you really need to think about that in the context of everything else. Because the technology is asset light, recurring revenues in most cases. In clean energy, the shift is accelerating. So no matter how many people tell you about Enbridge or other crappy oil assets, with the exception of a couple of Permian stocks, maybe ConocoPhillips because it's selling off assets and they started before everybody else, there's almost no fossil fuel investments out there worth the risk. And here's why. Because if oil does go up or natural gas stays up in price, the clean energy stocks still do better, right? Because they're more competitive. It accelerates the transition. And if there's a collapse in oil and gas, the collapse in clean energy will be less. So clean energy compared to fossil fuel investing just beats it in either situation. There is no positive long-term outlook for fossil fuels. And as the weather events get more extreme, at some point, enough people are going to scream for a solution that the government will give it to them. And we know that about 70% of the people acknowledge climate change. Not Ron Johnson, he's a dumb asshole senator from Wisconsin. And ultimately, there's going to be a demand for more aggressive action. How fast does that come? I'm not positive. But it's pretty hard to think that it's not going to come in the next few years, especially with the western part of the country burning again, with record temperatures in Canada in the hundreds, forest fires everywhere. Most of the desert Southwest about to become more desert. Only Las Vegas has really mitigated themselves by adjusting. And what did they do? They stockpiled water credits and they built 2 gigantic solar farms. Make sure people could still go down to that dusty hole under the sun and gamble. It really does remind me of some of the gambling establishments that you see in Star Trek and Star Wars and other, dystopian tilted space and science fiction movies and shows. But I tell you, I just got back from Las Vegas. Man, it is a smelly armpit all of a sudden. So when we take a look at everything that's going on, just really have to take a look at the big picture and where the secular trends are leading us. And it's a drier desert. It's mountains without snowfall. It's more heat. And right now, we really don't stand a chance in hell of mitigating the damage. It'd be 100 years before things are better if we really went balls to the wall right now to fix it. And carbon capture is going to be a big part of that. Hence, why we're in Kinder Morgan. Of all the fossil fuel investments in the world, that you'd want to be in, Kinder Morgan is one of them. Why? CO2 transport, biggest company out there. Natural gas transport, biggest company out there. Most of it. They hardly do any oil and liquids products. The natural gas is a backdoor to hydrogen, which we're going to probably use to store energy, store alternative energy, and maybe run the big vehicles. I think we probably will. You know, there's a horse race between EVs and hydrogen for the large vehicles. Not sure which one's going to win yet. But then carbon capture, Wood Mackenzie identified about 3,500 global used wells with caverns where we could store carbon. So that's coming. That's an industry I'm keeping an eye on for you. I'm not sure how big that's going to turn out, but I know the carbon's going to have to get moved. And that's where Kinder Morgan comes in for us. You know, all that saying, all the gin joints in the world, and I find you here. There's not a lot of fossil fuel investments I like, but Kinder Morgan still looks like it's going a little higher before a pullback. I told you there's only a handful of oil companies I'd ever look at. You can see them on the very short list, but they'd have to pull back a lot for me to buy them. And a lot of their competition would have to get wiped out. And I expect that to happen, which is why I leave them on the list. We'll talk a lot more about that on Friday. Friday's call is going to be the stock very short list. So let's get to this. Cash allocation, depending on if you're very defensive, so into retirement, cautiously optimistic, or pedal to the metal. Your normal long-term cash asset allocation would be 4 to 12% if you're defensive. Most people would be right around 10. A few percent in cash if you're cautiously optimistic. If you're pedal to metal, it's just your schnibbles that are in cash. Right now, we're about 10x in cash. So if you're defensive, you should be about 50% cash, give or take. If cautiously optimistic, 20 to 40%. I'm close, 40. Then about 10% of that is attached to cash secured puts. So really about 30. And I know a lot of you traders, those of you who like to use your money for swing trading, you've got lower cash balances, that's fine, because you have some of your trades and you're putting stop losses on. So what ETFs am I pretty gung-ho about this quarter? Well, for growth investors, Global Trends ETF, designed to have the same risk as a 80-20 equity to fixed income portfolio historically, but using 20% alternatives instead of bonds because bonds suck. So we can't completely overcome the correlation, but we can get some correlation benefits by not being 100% equities, pure equities. QQQ and BST, they're similar. If you want large caps, these are some of your core investments. And I have the percentages pretty low, and I'll show you in a minute that you can adjust this to fit you. QQQ and BST, the essential difference, other than very slight holding differences, is that BlackRock Science and Technology has the bond overlay. They sell bonds, generate income, and mitigate their risk. They've done a pretty good job. Invesco Wilderhill Clean Energy, I bumped it up to 20%. On pullbacks, I don't know which pullback. This is my buy zone, which I've adjusted here. I'm just talking about the orange box. So the orange box is really what I'm targeting. And then the yellow wider box is, you know, events could do something. So I wanted to give you a better representation of the buy zone. This is the range where I expect that I'll be buying. But I want to get to 20% PBW because it's done so well, and I expect that it will continue to do so well, and because there's an element of volatility that you can put to your advantage. So on those big pullbacks, you can really get long, make a lot of money. Take a look at chart. It actually seems to be playing out pretty close to what I suggested. So it came down, it went up, and I have this red arrow, and it looks like it's having a little bit more correction. So around 80, I'm going to add to it. If it gets down into the middle 60s, I'm really going to add to it. I don't think it's going to get down here. In fact, that little truck is supposed to be up a little higher. Red arrow should be about here at 80, and the truck should be in the mid 60s. But I do expect to set new all-time highs right around the presidential election. So if you can catch it down here in the 60s or 70s, you're looking at a double over 3 years. And it could go considerably higher. Because a lot of these companies are going to start churning out big profits. Arc Innovation, I settled on the Invesco Next Gen 100, which is the QQQ mid caps. So the next 100 companies after the QQQ, for the most part. And I did it because I think as Cathie Wood gets bigger, it becomes harder, and this is for any manager. As you get bigger, and it used to be 10 to $20 billion big, it seems to be a higher number now, but she's at about 50 billion. As you get bigger, it becomes difficult to invest in those smaller mid-cap names that she did so well in. Because she's got too much money, she'll move the market herself. And by virtue of social media and becoming a cult of personality, you can move the market a bit. We've seen it with Berkshire Hathaway. So we have to be careful, because just as they can push things up, when they take a hit, they really push things down because they're also a seller. And we saw that with ARK. When ARK was getting beat up, all those stocks got crushed. Because there's easy money out there and leverage, those stocks are getting pushed back up. I don't think the last leg down has happened. Elliott Wave would indicate there's one more leg down. And really, any other analysis would indicate there's another leg down from wherever this peaks. So I would buy ARK Innovation, right? Looks a lot like the PBW chart, doesn't it? Had to check to make sure it wasn't. 80s, maybe 90s. Again, this is the Armageddon scenario. And the reason I had these down there, and I've changed my mind, but the reason I had the truck way down here is because a lot of analysts that I respect are saying that the bottom is probably just above the January 2020 level. That this plateau to here was the next step up. But with all the money that's gotten printed in the last year, again, we're not going to do a definition check there. I don't know that it can get this low just because of all the easy money that's out there. I do think buyers come in pretty heavily in these middle levels. And we'll see. We'll see. We'll see. I don't know if they're here. Yeah, 2 levels of buying, right? This represents 2 periods. This period and this period, actually 3 periods in that period. This area represents 1 time period here. Will that be enough to support all this buying that's up here? Might not be. So it might actually get down to the Armageddon level. And these companies with ARK Innovation are susceptible to it. Why? Because they're smaller companies. When people sell off, they get crushed. QQQJ, which is the mid caps, right? They introduced this in the middle of 2020 and went straight to the moon. Right? Middle 20s and middle 30s. Now it's been choppy, been jitterbugging. Here and here seem to be the 2 spots. This is actually right. You can't see the orange line. But I'd really be interested in these companies here. What are those companies? Roku, CrowdStrike, right? A number of the innovators. Interestingly, Viacom, right? That's one that we've been buying. So if this went from middle 30s back to under 30, that's at least that's a 10 to 15% correction. This is more like 20%. It could actually come way down here if bad things are happening. But I like the index approach here because it's getting hard for Cathie to be Cathie. Berkshire Hathaway, what do we like about that? Well, if his share price goes too low, he'll just start buying back the shares. But we should expect a correction. He probably went buy his own shares at 240, maybe not even in the 220s. But it seems like, because he bought just under 200 the last time, at 200-ish is where he'd start buying. Maybe that's what these represent. So somewhere in here, you really want to load up on Berkshire if you don't have it, because it's one of the safest ways to play the stock market. Maybe not the highest earning way, but you want to balance some of your risk with something that's less prone to a huge sell-off. And they have so much cash that if they just wanted to buy $50 billion worth of their own shares, they could. Semiconductors, we know it's a secular bull market, but it's very overvalued. I added some weed, cannabis, CNBS, cannabis. Why did I get this one? I think they have the best manager. So of all the cannabis ETFs, Tim Seymour, who you'll see on CNBC, is one of the guys I think is best on CNBC, is a pretty big time cannabis investor, coming at it from kind of a private equity standpoint. And it's only got about 35 holdings, but it's diversified across growers, distributors, real estate, the different technologies involved, biopharma applications. So he has a little bit wider scope of what he can do, what he can invest in, and it's had the best relative performance compared to the other ETFs. So ultimately, we want to look for relative strength in our investments. And if two investments are similar, but one consistently outperforms, that means somewhere along the way it has an edge. Usually that edge is management. So I'm looking for spots to buy into the weed revolution because I smell it freaking everywhere I go now. And the US brands just got a break from the banking system. Federal government said the banking system can interact with the cannabis companies now. And that's really going to help them normalize. It's going to show people what they're really earning. And it's just a quarter away. This is something that I think you can both trade as a swing trade. And I hope Scott really gets into this one. I will ask him to. But also, I think you want to hold it for a longer cycle. Van Eck Rare Earths, why? Pretty simple. Supports high tech and clean energy. And we know that those supply chains are trying to move back here. It's going to take a number of years. So there is exposure to some of the commie stocks. Again, I'd rather have my commie stocks in a fund. I just don't want to hold any of them independently because of the commie government risk. We have to build our own REITs basket. We've got 5 of them that we like. And I'm going to add 5 more on the VSL or on the plug and play. Because if you want to have 10 REITs to spread out your risk in that sector a bit, I think that's reasonable. 10 REITs at 1% each. Van Eck Gold Miners, I brought that down to 10%. Why? Because in an 80-20 portfolio, you'd have 20% bonds. And I'm looking at the REITs and the gold miners because they're less correlated to the broad S&P 500. These are our bond substitutes, especially for more aggressive investors. There's just no way to legitimize buying bonds right now. I've looked through preferreds, I've looked through convertibles, and I've just looked across the board. If we take a look at the high yield bonds, the spread is the narrowest ever with investment grade. That always results in something bad. So I don't want to screw around with it. I'd rather hold extra cash as I work my way towards these asset allocations on corrections and buy the dips. And then finally, emerging markets. I don't have any diversified or dividend equities for the growth investors, for global trends folks. But the best place to invest overseas is clearly the emerging markets, clearly the asset light space, internet and e-commerce, cloud, e-commerce, that sort of thing. Blown away virtually every other international fund. So we can get it on pullbacks. We'll want to. So we had this big rally. Now it's coming back. We get it around 50. Probably need to get in there. When you get it around 40, get in there a lot. Because that seems to be at a support level. Yeah, hard time believing it goes much below 40, even middle 40s. And I think that this area right here just under 50, probably is going to hold unless, again, something bad is happening, and we'll have to measure that at the time. For the Retirement Trends ETF, really want to load up on the BlackRock Science and Technology Trust, quarter of the portfolio. Why? Because it's basically QQQ managed with the option selling overlay, which cuts your risk by 10, 20% by piling in income and getting you out of things that rally too much. Pretty basic. They sell some puts too. And the performance here has been very similar to QQQ. You know, if you take a look at QQQ and BST, depending on the exact time frame, BST even outperforms once in a while. So again, go back to here from almost day one, QQQ slightly outperforms, but more recently, BST has outperformed. It depends on the time frame. And this is a choppy period in the stock market so far this year, even though it's going up. BST, keeps a little edge. Why is that? In a choppy period, a lot of those options will expire. They just collect the cash. They get to hold on to the position too. So choppy or down, BST will outperform by several percent. In an up market, QQQ probably outperforms. So let's take a look at from directly at the bottom if that holds true. In this particular case, it didn't. BST even outperformed from the very bottom. So in any case, they basically track. And for your income investors, it's a way of collecting a few percent more in dividend than owning QQQ, which is what you want as a retiree and a dividend investor. I actually think this is pretty good for your global trends portfolios. You could go entirely with BST if you just want income trickling into your growth portfolio so you can buy other things. And in here, I have some notes about that. I mean, if you want more in large caps, then just reduce ARK and QQQJ. And in fact, if you only wanted to use QQQ and QQQJ, you could. If you only wanted to use BST and ARK, you could. Depends on how you feel. I like splitting it up. But if I was going to do anything, I'd probably use all BST because I like to have cash flowing into my portfolio. I should mention this. I removed the Cushing Renaissance Fund due to the valuation and because the fossil fuels represent about 25% of their portfolio. Just didn't want to deal with it. Down here, if you are a retiree, we mentioned XLC a few months ago, like kind of right after we did plug and play. It rose. The neat thing about that is the portfolio. So XLC is Google and Facebook is about half of it. They reach like 20 some odd percent. But then it's buoyed by dividend players like AT&T, Comcast, Luma Technologies, and then streaming companies like Netflix, Disney, Viacom, which is kind of in here too, and Discovery. Notice anything familiar about the holdings? I've mentioned every single one of those in the last year. So I really like XLC. I think it's a great one to buy on pullbacks. And as a retiree, you're going to get a couple points of dividend. Now, if you start doing your own option selling overlay on this, make a few more points. Basically, double or triple your dividend yield. And if your yield between dividends and option selling can be 7, 8, 9, 10% a year, gee, that's pretty good on top of whatever this grows. Utilities, I've talked about having a consolidation period, but the thing to remember about utilities is we're never ever going to not need them. But the nature of their business is changing. But what do we know? We know the government's going to support them. This might be the most government supported industry out there after banking because we need them. Maybe healthcare, I don't know, but it's very heavily government supported. So if they need loan guarantees to convert to clean energy, they're going to get loan guarantees. If they need grants to rebuild the transmission system, they're going to get grants to rebuild the transmission system. So during those periods when people are pessimistic about utilities, you're going to want to buy them as a retiree because there's not a lot of downside. They pay the fat dividend no matter what. The government's always going to bail them out or help them out. So this is a great retirement investment. And if you do the very slow ebb and flow trading on it, a trade a year maybe, and literally a trade a year, maybe two, you're going to do pretty well. Again, Berkshire Hathaway, gold miners, and then emerging markets. We do have the Wisdom Tree International Hedge Equity because the international diversification will give you more safety. You could add that up to global trends if you wanted to, if you're more conservative. And then PBW because it's such a giant trend, and it pays a dividend too. So that's really it. Here's the article. Make sure you read it. I updated the Using Global Trends ETF updates. So that's every week I'll do a quick piece on global trends ETFs, just anything that's kind of out of the ordinary. Then we have the swing trading, position trading update from our new technical analyst, Scott Henderson, who hopefully is going to help us supercharge the service a little bit and get your trading, whatever level of trading it is you do, whether it's several trades per year or several trades per quarter. I think he's going to be able to help. And we have it set up both looking at the long term and the intermediate term. And then I gave him a little bit of leeway to do some short term trades for those of you who are aching for excitement. So this is an updated article. All right, if you have any questions, go ahead and mention them in the chat. Make sure you tag me. And on margin of safety, you can put questions right underneath the article. I still don't do comments on fundamental trends. I just like to leave it in the chat. All right, everybody have a great night. And remember, bucks and six.